And back with us, Walter Todd, the co-chief investment officer at Greenwood Capital. In January, he forecast a very volatile stock market, gaining early in the year, then falling and trading sideways. Sounds just like the market we've been having this year. So, Walter, I'm going to start with you because it seems like your call has been pretty good for this year. So what happens from here?
Well, admittedly, the market decline is happening maybe for different reasons than we anticipated, but nonetheless, you are seeing a nice pullback off of the April highs, and I would expect the market to...
You say a nice pullback. You like this pullback. You think it's healthy for the market?
Oh, absolutely. I mean, I think there's much less risk buying the market today than there was a month ago. I mean, there's some issues out there, which I'm sure we'll talk about, but I think this is a healthy pullback for the markets, and I think it's an opportunity to put some money to work.
Let me ask you, we just talked to Mark Faber. He kind of agrees with you, basically. He sees a rally here for at least a little while, but doesn't think we'll eclipse the highs in the S&P of 1219. Do you think we're going to get past that?
I think eventually we will. I think it will take some time. I think as we move through the summer, the typical summer malaise that we have, it will probably be choppy trading. So I think you have to pick your spots. But I think when you see the opens like we did today, where we have the downdraft, that's where you want to have your buy list ready, and you can get in there and pick off some attractive stocks.
Hey, Walter, it's Julie here. I wanted to ask you a little bit more about one of the events that John just referred to. That is the talk about what's going on between North and South Korea. Periodically we get these headlines on whatever political situation it may be around the globe, and we tend to see the markets react like this. But, I mean, how fundamentally could this situation affect the global economy, for example, or could it? Are people overreacting, I guess is what I'm asking.
Well, there are plenty of geopolitical risks out there, but I think you have to believe at the end of the day that China recognizes that having an unstable situation over there with North Korea is not in their best interest. So you just got to hope that they're going to intervene, and I think they will, to try to settle that circumstance down. But it's difficult to make investment decisions based on those type of risks, although they are out there.
Walter, let me ask you, do you think people forget how interconnected these financials are? I mean, is it a problem if you start thinking about European banks as so separate from U.S. banks? Because they obviously are counterparties on a lot of deals.
Sure, and there's some exposure there, but I think you have to, again, the yield curve is flattened, but it's still incredibly steep. So it's still a good operating environment here in the U.S. for these banks. So I think we kind of know what the financial regulations is going to look like. You alluded to the comments that Barney Franks made today that maybe lessens some of the impacts, but I think financials are attractive here. And I would just say one comment on the material stocks is one of the silver linings of all this uncertainty is I think China takes their foot off the brake and perhaps re-accelerates on their end, which would be positive for materials.
Let me ask you, though, quickly about the European financials. I mean, do you have concerns that we actually see a collapse of some large European financial organizations, and would that be a problem for us? I mean, Jim Bullard came out today and said even if the European financial system has its problems, it's not going to affect our recovery.
I would tend to agree with that. I mean, there's the risks of the financial transmission mechanism in terms of the cost of capital, but in terms of a fundamental impact on the U.S. recovery, I just don't think it's there. It's a risk for sure, but I don't see it.
Guys, we spend a lot of time talking about what's going on in the credit market, understandably so, whether it's LIBOR and so on. Walter, should we be focusing so much on it?
Well, it's definitely something to watch, but as you just alluded to, I mean, the absolute level is still very low. It has doubled from 25 basis points to just over 50. So I think it's something you keep on your radar screen, and it is definitely driving equity markets in the short term. But I wouldn't overly focus on it.
John, Walter, you actually like some of those energy names. You think they're attractive?
We do. I mean, the energy sector has been absolutely hammered for a variety of reasons. One, the oil spill, but also the pullback in crude. And interestingly, without the weakness in the euro, the strength in the dollar, I think oil should fundamentally be higher as a result of the spill. And so I think you'll see oil move up from these levels. And I think there's a very attractive opportunity in the service names, particularly because there's going to be more service required on these rigs. There's no question about that. And even some of the big integrated names, I think, look attractive at these levels.
Walter, let me ask you about the importance of China here, because John brought it up earlier. You talked about it a little bit as well, and you mentioned the weakness in the euro. Mark Faber was on with us earlier saying this basically helps the yuan appreciate naturally, at least against the euro. Is that a problem? Because we want them to let the yuan appreciate, and clearly they're not in any position to start doing that.
Well, I think the bigger impact in the near term as it relates to oil specifically is them taking their foot off the brake in terms of their tightening. So if their economic activity can reaccelerate, and it's funny to talk about reaccelerating from 9%, but if that can improve, I think that's a bigger driver than currencies are on commodities.
All right.
We're going to run. Hey, guys, thank you so much.